Okay, welcome to ABD Office Hours. Thank you again for joining. The topic for today is the ACA Potluck guidance. The IRS provides a full serving of new ACA guidance, and we'll explain why we're calling it the ACA Potluck in a second. I want to first briefly mention that we had such a high turnout for the live webinar that it crashed our recording of the webinar. So I'm just going through and running it without Liz today, but thank you very much to Liz for doing the live webinar with us. We got great feedback and we really appreciate it. As always, she's done a number of webinars with us and it's always well received and we're always very grateful for that. So if you're listening to the recording and you're hoping to hear her voice, apologies, it's just going to be stuck with me, but thank you again to Liz for doing the webinar with us. All right, so let me do a couple quick housekeeping items. One, of course, the slides for the decks are always posted under ABD team, theabdteam.com. You go under ABD Insights and you click on presentations and the deck will be there. Two, we're going to go pretty quickly, or I'm going to go pretty quickly through these because it's hard to keep this within a 45-minute time frame because there's a lot of material to cover. So there'll be more detail on the slides than I cover in the presentation, but that's so you'll have the takeaway information if you need it, and I'll cover what I think is really the important items to hit on. And three, I just think that you should conceptually approach this in a way that you sort of sit back and digest it instead of furiously taking notes or really trying to memorize what's going on, because there's too much information here to really memorize. You know, just take my word for it. I've tried to, and it's sort of mind-boggling. What's really important in our daily practice is that when an issue crosses our desk, and we have a lot of issues cross our desk, that we're able to issue spot what's important there. So when something comes across your desk and involves an HRA, or involves a $500 health FSA carryover, involves an individual policy arrangement, involves coverage for interns, you'll know, oh, there's some issue with that. I remember Brian and Liz talked about it in a webinar. I'll go back and look at the slides. I'll ask one of them. What have you. It's not that you have to remember exactly what all the detail is there. It's that you know that there's something to be concerned about that's really the key. So if you approach it that way, I think this whole experience will be more fun. Okay. So the ACA Potluck, well, it's officially named the IRS Notice 2015-87, but it's sort of become informally better known as the ACA Potluck Guidance because it covers such a broad array of ACA issues. And most of those issues were sort of left unresolved or not well understood to this point. So we're grateful to have it. Unfortunately, it did come right the week before Christmas vacation, which was difficult because everyone was in the holiday spirit and not really in the potluck, ACA potluck spirit. So now we're finally starting to digest all this, and I think this presentation will really be helpful in that manner. What are the main topics? Well, there's a number, even more than we're covering in these slides, but these are the main ones we think that you will care about. The first is HRA integration guidance. So how to avoid the standalone HRA compliance issues. The second is prohibition of individual policy reimbursement. It's really become the IRS sort of obsession to come out with new guidance, I think, on this issue. We'll talk about why and why it matters. ACA affordability. Opt-out credits and flex credits just got trickier when it comes to determining ACA affordability. We'll go through that. And also there's new inflation adjustments for the affordability safe harbors that we'll discuss. The ACA penalty, the pay-or-play penalty amounts for 4980H have been indexed for inflation to slightly higher amounts. They were already very large. They've just gotten slightly more large, particularly that big A penalty. And we'll go through what's new for 2015, in particular that new 95% substantial offer of coverage requirement and where that we are concerned that could be a big issue for you. HSA rules for vets. We got new legislation last year that expanded HSA eligibility for vets. And then the health FSA carryover up to $500 has been around for 3 years, I think now. And now we're finally getting some more detail on exactly what the limitations there are. All right, let's start with the ACA HRA integration rules. What this is about is it's about avoiding having a standalone HRA. standalone HRA means that an employee would only be eligible for reimbursement under the HRA and not be covered under a full major medical. The problem there is that the HRA is a group health plan subject to all the ACA requirements just like a major medical. So unless you're sort of combining the HRA with a full major medical to come up with one full group health plan that's integrated, the HRA by itself isn't going to satisfy all of the ACA market reform provisions, in particular the lifetime and annual dollar limits requirement, prohibition, and the requirement, the mandate that non-grandfathered health plans reimburse preventive services at no charge, right? Standalone HRA by its nature is a fixed dollar amount, so we'll have dollar limits. And when you submit to reimbursement through an HRA, money comes out of the HRA. It doesn't stay flat generally, so it would be difficult to reimburse preventive services at no charge. So how do you avoid that? You integrate the HRA with a major medical, and there's two different methods depending on whether the major medical provides minimum value or it doesn't provide minimum value. But the real key is that the employee be covered by a major medical plan that's a group plan, all right? So it doesn't necessarily have to be that employer's group plan. It could be a spouse's or parents or domestic partners, but it's got to be grouped. It can't be an individual policy. Just like you can't reimburse an individual policy, you can't have an HRA integrated with an individual policy. So in other words, I could be an ABD employee and have access to an ABD HRA, and I might not necessarily be covered under the ABD major medical, but I might be covered under my spouse's group major medical, and that would be fine. I would still have integrated coverage. What would be a problem is if I only had individual, for example, major medical coverage, like on the exchange, then my HRA would not be integrated, and that would violate the market reform provisions. So what's new? Well, if you go back to the original guidance on standalone HRAs, which is better known as the Friday the 13th guidance, it came out September 13th, 2013. And I'll always remember that date because my first son was born the next day, so I remember sitting there in the labor delivery room trying to understand this Friday the 13th guidance. But if you go back and look to that, you only see references to the employee, meaning only that requirement that the employee be covered under major medical, no references to spouses and dependents. Well, there's a number of HRAs that are what the IRS calls family HRAs, which will reimburse expenses not only of the employee but also the spouse and dependents. So what the IRS is now saying in this Potluck guidance is that in order to satisfy those HRA integration rules, any family member also has to be covered under a group major medical policy, not just the employee, so that you failed to integrate the HRA if a spouse or dependent is eligible for reimbursement under the HRA and not covered under a group major medical. Where is that going to come up? Well, the most common scenario would be if someone enrolled an employee only covered. Let's say I enrolled an employee only covered at ABD, and it's a high deductible plan, but we don't use HSAs, for example. Let's say we use an HRA as a cost-sharing vehicle to cover expenses for that high deductible. Well, if that HRA would also reimburse expenses of a spouse and dependent, even though I'm an employee-only coverage under major medical, then you've got a problem potentially, right? Because my spouse and dependent might not have major medical coverage as group, and therefore my HRA coverage for those family members would not be integrated with any group major medical. So what you can do is you can automatically structure your HRA to only provide coverage to those who are enrolled in the major medical, and that will sort of de facto satisfy that issue for you. There's transition relief because the IRS realizes that a number of family HRAs out there didn't comply with this rule. So what they're saying is they're not going to enforce until the first plan year beginning on or after 1/1/17. So if you got this situation, you got plenty of time to make the changes needed to make sure you got an integrated HRA for the start of the next plan year. All right, individual policy reimbursement prohibition. As I mentioned before, I really think this is borderlining an obsession at this point with the IRS because they come with so much guidance on it. What's the issue? Well, it's similar to the standalone HRA issue. If you provide a dollar amount to an employee to reimburse coverage, individual policy coverage, for example, on the exchange, that dollar amount that you provide the employee, not the ultimate policy that the employee uses the money to buy on the exchange or what have you, that actual dollar amount that you provide to the employee is considered a group health plan. And because it's a group health plan, it's subject to the ACA market reform provisions, and it cannot satisfy those market reform provisions. It has annual and lifetime dollar limits, it doesn't reimburse preventive services without charge, etc. same issues as standalone HRA we just talked about. There's a lot of employers who did have individual policy reimbursement arrangements before the ACA came out, so they've been sort of bombarding us with guidance, reminding all employers, or sort of not reminding, but trying to get the news out to everyone that this is now a change that is no longer permitted. I don't think the word has fully gotten out there because I'm still seeing situations where employers are doing one-offs on this and we have to remind them of how important it is not to do that. If you're doing it, I really suggest you end that practice immediately because the penalties are enormous. It's $100 per day per employee, which comes out to $36,500 per employee per year, all right? Enormous penalty. I don't think the IRS has actually enforced on this yet because I think it will be big news when they, if and when they actually do enforce on someone because, you know, ACA stuff generally is big news and this would be a major penalty. But I think it is one of their top enforcement priorities, so I think it's likely that we will see enforcement on this. Perhaps not this year because it's an election year, but if the ACA stays in place as it is, I think it's likely we will see enforcement action on this more so than any other market reform provision. I think this and payer play are their biggest priorities. That's my sense. What can you do? You can provide additional taxable cash compensation to employees. You can always do that. You can give them a raise, you can give them a bonus, what have you. It's taxable. That's the difference. And it cannot be conditioned in any way on the employee substantiating individual policy purchasing. So, right, so you just give them another $500 per month, you tax it, maybe even gross it up if you want to be generous, and they might use it to buy a new flat screen TV, or they might use it to buy an individual policy. You won't know and you won't have any ability to condition on that, but you have avoided that $36,500 per year penalty by structuring it that way. So what's new in the potluck guidance? Well, everyone had sort of assumed that accepted benefits would not be included in that individual policy reimbursement prohibition, and that's because accepted benefits are accepted from the ACA market reform provision, and the IRS has now confirmed that that's correct. And so the main accepted benefits are dental and vision only policies. So if you've got an individual policy reimbursement arrangement or an HRA, and the only thing that those arrangements can do is reimburse individual dental or vision, you're fine. Okay. The big issue there to be aware of is that you have to explicitly limit that arrangement or HRA to only accepted benefits, right? The mere fact that it could be used for non-accepted benefit, like a full major medical on the exchange, will violate the market reform provisions and subject you to the same $100 per day penalties, even if the employee didn't end up using it on that. So in the terms of the HRA or other reimbursement, make it very clear, look at this example here, make it very clear that it's only available for dental or vision policies, because it's an example, the HRA was available for dental, vision, or other reimbursement, and that would violate the $100 per day penalty provision just in the same way as an individual policy reimbursement arrangement directly for medical would. So as long as you're clear, it's limited to accepted benefits, you'll be fine, you'll avoid that penalty. Payer play affordability. One of the big issues with affordability with payer play is that most of the rules, or at least a lot of them, are designed for the individual mandate side to make sure coverage is affordable for individual mandate purposes, and therefore you're subject to the tax penalty if you don't maintain minimum essential coverage for the year. So it doesn't translate particularly well to the employer side because on the individual side, they're looking at household income, and on the employer side, you don't know an employee's household income, right? Because on the individual side, they've got your full tax return to look at. So the IRS came out with these safe harbors, federal poverty line, rate of pay, and Form W-2, that you use sort of as a proxy for household income, and that's how you determine affordability for the payer play purposes. Well, on the individual mandate side, they'd always index at 9.5% for inflation, but they hadn't done that explicitly in the regs that implement these payer play safe harbors. So we were sort of stuck at the 9.5% until they told us otherwise. And now they have told us otherwise. They're saying they're going to amend those regs. They'll say those index for inflation just like on the individual side, which means that instead of 9.5%, we're up to 9.66%. We're determining the lowest cost plan, the employee share of the premium for the lowest cost plan on a monthly basis. How much does that cost? That's the amount that you're using to determine affordability. So by far and away the best safe harbor is the federal poverty line safe harbor. It's also perhaps the costliest, right? But what it says is that if your cheapest plan option, the monthly employee share of the premium for your cheapest plan option at the employee-only tier, It's within 9.66% now of the federal poverty line. The federal poverty line for 2016 is up to $11,880. Your coverage is going to be deemed affordable for all your employees. You won't have to do any kind of analysis on who your lowest paid employees are, et cetera. So what that means for 2016 now is you can charge up to $95.63 for your cheapest plan option, and your coverage will be deemed affordable for everyone under this federal poverty line safe harbor. Now, the other bonus here is that if you meet the federal poverty line safe harbor, you will likely qualify for the qualifying offer streamlined reporting method on the 1095-C, which means you can put 1A in line 14, and you can leave line 15 blank, and you might even be able to leave line 16 blank. That isn't totally clear at this point. So it is a big benefit to be under the federal poverty line safe harbor because it's deemed affordable for everyone and you get streamlined reporting. The other affordability safe harbors are rate of pay, which I think is the go-to safe harbor if you're not meeting federal poverty line. And Form W-2, we don't recommend that one because you don't have predictability, and a number of types of comp, including 401k deferrals and 125, cafeteria plan salary reductions don't count in the box 1, so you're reducing the amount of comp that you're taking the 9.66% off of. So Form W-2 I think is not a good approach, but the rate of pay is probably the best approach to use if you're not using the federal poverty line. One thing I'll mention is that a lot of employers are starting to get into strategy sessions now for 2017 coverage, and that includes what the cost will be to the employee. If you have a plan that costs roughly around the federal poverty line, but it's slightly more, think about dropping that down. Like if it's $100 per month for your cheapest plan, think about dropping that down to $95 per month. And then you'll meet this federal poverty line safe harbor. You'll get streamlined reporting. Coverage will be deemed affordable for everyone. I think it's probably worth it. You know, whatever that $5 drop or whatever much you have to drop it to meet it costs you, you could probably make up for it by charging slightly more for other plan options, for dependent coverage, et cetera. Okay, HRA contributions. How does that affect the affordability analysis? Well, if the HRA contributions are available to apply toward premiums, then they will reduce the amount of your cheapest plan option cost. So I think it's probably much more common at this point to see an HRA that only is available for cost sharing, like copays, deductibles, coinsurance, et cetera. But there are some HRAs out there that you can also apply to premiums, so you can apply to the employee share of the premium for your plan. If you do have that latter setup, then you can take whatever amount that HRA makes available each year and reduce your lowest cost plan option by the amount of the HRA contribution, and that will effectively be what your cheapest plan option costs. So there's an example here at the bottom. Assume that your cheapest plan option costs $200 a month, and the employer makes $1,200 available to employees annually through an HRA, and that HRA could be used not just for cost sharing, but also for premiums. That would mean that you take 1/12 of the $1,200 and you get $100 per month, and you'd be able to reduce, therefore, your $200 per month cheapest plan option by that $100 per month. The ultimate result is that your affordability analysis will be based on $100 per month, not $200 a month, as a result of those HRA contributions. So in line 15 of the 1095-C, you'd be putting $100 per month instead of $200 per month based on that HRA contribution. What about flex credits? Well, most employers assume that flex credits would count toward the affordability calculation prior to this guidance, but now we have some stricter, perhaps than anticipated rules on what exactly those flex contributions have to look like in order to count towards the affordability. And so in order to apply a flex credit toward affordability, it has to be deemed a health flex contribution. And to meet the health flex contribution standard, you have to make a three-part test. The first is that the employee cannot opt to receive the amount as a taxable benefit. What does that mean? It means it can't be a taxable flex credit. I mean a cashable flex credit. So if you don't apply the entire flex credit to the qualified benefits under the plan, the remainder, the balance of those flex credits must be forfeited instead of being available as all or some of that available as taxable cash compensation to the employee, right? So like if I had $100 per month in flex credits that I didn't apply to any benefit, some plans will say I can take that $100 per month as taxable cash. if you do have it structured that way, these rules are saying it will not qualify as a health flex contribution, and therefore that flex credit will not count toward your affordability calculation. Number two is you have to be able to use that flex credit toward the major medical plan. I think that's obvious. You would assume that the flex credit wouldn't affect affordability if you couldn't apply it to the major medical. And the last one, which is also tricky, is that the amount has to be exclusively available for health premiums, meaning medical, dental, vision. It cannot be available for other welfare costs, like voluntary life buy-up or STD, LTD, or AD&D. It has to be exclusively available for medical, dental, or vision costs. So a lot of flex credits out there will say that you could apply it to any of the health and welfare benefits under the plan, whether it be medical, dental, vision, life, disability, AD&D, etc. You have to, in order to get them to count toward the affordability calculation, you have to explicitly, first of all, it can't be cashable, like we said, number one, and two, you have to explicitly limit the availability of those flex credits to just medical, dental, vision if you want it to count toward your affordability analysis. More transition relief, again, the IRS realizes that a lot of employers weren't aware of these conditions. So in order to provide some temporary relief, they're saying that before 1117, if you've got a flex credit that didn't meet these health flex contribution requirements, you're fine. You can still count it toward the affordability calculation, with the small caveat being don't increase it substantially before 2017, otherwise we'll take away that transition relief. Opt-out credits, I think this is let's back up a second. Flex credits I don't think are that popular at this point. I think it's maybe like 15 to 20% of plans I see have flex credits. Opt-out credits I do see as being very popular. Maybe half, maybe even slightly more of employers I see with an opt-out credit, which says that if you waive the medical plan, you'll receive some amount in taxable cash compensation as your incentive to waive, right? The employer's not going to have to pay the employer's share of the premium for whatever medical plan, so they're going to be getting some kind of cost savings for that, and as a result, they'll pay you some amount in just straight taxable cash compensation. And all that's done through Section 125 cafeteria plan, and it's all kosher under those rules. The very unintuitive, strange part is that now the IRS, and this had been out there on the individual mandate side, but hadn't directly been applied to the pay-or-play rules until now, is that the IRS is saying that you have to add the amount of the opt-out credit to the amount of your cheapest plan option when you're determining affordability. So think about that one for a second, and I think it'll make more sense when we go through this example. And the example here is that an employer offers $100 a month as their opt-out credit, right? So if you decline the plan, we'll give you $100 in taxable wages as an opt-out credit. In this example, the employer's cheapest plan option costs $200 if you elect to enroll. Well, what does that mean for affordability? On line 15 of the 1085C, when you're doing your affordability analysis, you would not be doing it based off a $200 per month cost. You'd be doing it based off $300. And the reason is because you have to add the $100 per month opt-out credit to the $200 per month cost of coverage to get the total affordability analysis cost of coverage. Here's how they think of it. They think of it that if you elect to enroll in the plan, not only are you going to have to pay $200 per month as your employee share of the contribution, you're also going to have to forego the $100 per month opt-out credit. As a result, you're effectively paying $300 per month to enroll in the plan, because by enrolling, you pay $200 and you're giving up $100, right? It's like an opportunity cost thought process. So that's the way to think about it. That's the way it's supposed to be applied, and they give us the broadest transition relief here because they realize very few people were aware of this up to this point. So what they've said is that if you had an opt-out credit in place when this potluck guidance came out, which is the end of last year, December 16th, you don't have to add it to your affordability calculation. We're going to come out with regs at some point saying probably you will, but until then, you're fine. My guess, or speculation really, just is that if they don't come out with regs by midsummer, it'd be hard to say that they could apply this for 1117. But until we hear otherwise, I think we should sort of operate on the assumption that this could apply for 1117, and therefore we should start preparing as though an opt-out credit will be added for 1117. Again, once the regs come out, we'll send out notices and alert everyone of when the effective date is, but at this point we don't know, so I would assume the worst until we hear otherwise. Okay, pay or play penalties. The A penalty, the big sledgehammer penalty on the left-hand side, the B penalty, the smaller tackhammer penalty on the right-hand side. If you only sort of really internalize one thing about this 6-year saga of the ACA, I think this is understanding the pay or play penalties and how you're subject to them potentially is the most important thing because the liability is so big. And by the way, yesterday was the 6-year anniversary of the ACA, so we're officially 6 years in, March 23rd, 2010. What is the big concern here? Well, first of all, what the Potluck guidance said is it increased the A penalty liability from $2,000 a month to $2,160, and the B penalty from $3,000. Let me back up. The A penalty was $2,000 per year, and now it's up to $2,160 annualized, $180 per month, because the penalty actually applies monthly. But the annualized amount, if you're subject to the penalty for each month in the year, would be $2,160. And then on the B penalty side, it's $270 a month up from $250, which comes out to $3,240 annualized up from $3,000. Not really worried about the B penalty. That's a small penalty, less usually than the cost of the employer share of the premium, so it's not a big deal. The A penalty I'm very worried about, and the reason is because you have to offer coverage to substantially all of your full-time employees to avoid this big nasty A penalty. And last year they had this transition relief which said that we'll consider substantially all of these 70% of your full-time employees, meaning you had this big buffer zone margin for error of up to 30% of your full-time employees, where if they didn't get an offer of coverage, you're still fine, no A penalty. There's potential B penalty liability, but again, I'm not too worried about that. It's this 2160 multiplied by all your full-time employees minus the first 30 starting this year that I'm really worried about under the A penalty. So the biggest concern here is the inadvertent situation where someone's offering a group health plan. Okay, they haven't exited the market. They haven't just decided we're going to pay instead of play. They're still attending to play. But they end up offering coverage to something like 93% of their full-time employees. How would that happen if you set eligibility at 30 hours of service per week to the ACA full-time employee definition? Well, the way it would happen, I think, most likely would be contingent workforce. So things like temps, interns, outside staffing workers, on-calls, casuals, any type of worker who traditionally was not offered coverage, but they do work at least 30 hours of service per week. And therefore, either under the monthly measurement method or the look-back measurement method, depending on which approach you're applying, they could be considered full-time and trigger potential pay or play penalties. So the key there is to just really nail down all your workers who might work 30 hours of service per week. If they're on your payroll, like temps and interns, really understand that limited non-assessment period rule, which generally says you have until the first day of the fourth full calendar month of employment before the full-time status applies and the requirement to offer coverage to avoid potential penalty applies. There are exceptions to that, so understand those rules. And if they're not on your payroll, like they're coming through an outside staffing firm or temp agency, understand how the contract has to be structured to be treated as having offered coverage to those workers, even though you're not offering coverage under your employer-sponsored group health plan. All right, let's talk about hours of service. Again, an ACA full-time employee under the pay or play rules means averaging 30 hours of service or more per week. And I'm focusing on the left-hand side of the slide here. When you are actively at work, sitting at your desk watching an ACA webinar, you're performing active duties, you're getting paid for that. It's obviously performing an hour of service that account to your 30 hours per week. The second item on the bottom left here, inactive payments, if you are in Scottsdale enjoying giant spring training, you are not at your desk, not performing active duties, but if you're using your vacation or PTO time to do that, you're getting paid for one of those A through H items on the bottom left there. You're still getting hours of service just like you're at your desk, which means you're still going to be considered full-time, right? So vacation, holiday, illness, those are pretty clear. The hardest part of this is incapacity, which includes disability. because you could get paid through a variety of different sources while you're disabled, and it wasn't entirely clear whether all of those different sources counted as inactive payments that would still result in hours of service for full-time status. So what do we have from the potluck guidance? We have confirmation that payments made for disability are considered made by the employer regardless of whether they're made directly by the employer. So like if you had a payroll practice, STD, and you're just paying after your payroll, obviously that would be hours of service. But what was less obvious is what if you had an insurance arrangement where the STD, LTD are insured by an insurance carrier, and when someone becomes disabled, it's the carrier paying the employee, or a trust fund. In either case, the IRS is saying counts as hours of service. It doesn't matter that it's not being paid directly by an employer. All that matters is that that employee is getting paid for one of those A through H items, and one of them was disability, right? So even though the payment's coming from a disability carrier, it still counts as hours of service. On the right-hand side, what's excluded? Well, workers' comp is excluded, unemployment is excluded, state statutory disability plans like California SDI, and a few other states have them as well. Those are also excluded from hours of service. Those are not considered payments made by the employer. And then the last one on the bottom right would be if you had an arrangement where the premium was paid exclusively by the employee on an after-tax basis, which I think is pretty rare and it's probably not likely to come up, then the benefit payments coming out would not be considered hours of service. But again, I don't think usually you see disability structured to have only the employee contribute and only on an after-tax basis. Okay, HSA rules for vets. We got new legislation slightly expanding this summer, I believe, of last year as part of a broader VA reform bill. Backing up to the general HSA rules, in order to be eligible to make or receive HSA contributions, you have to be covered by a high-deductible health plan on the first day of the month, and you can't have any other disqualifying coverage, which generally means any coverage that will pay pre-deductible. There's a special rule for the VA because the VA will pay pre-deductible, because I think really because the IRS realized that a lot of vets, first of all, most vets are eligible for the VA, so it's a huge portion of the population. And second of all, many of those vets don't actually access VA services because they have coverage through an employer-sponsored plan or some other plan that they might think provides better services. So it'd be pretty unfair, I think, to say every vet who has VA eligibility would not be HSA eligible because for the rest of their lives they'll have VA eligibility, and that would be disqualifying coverage. So the special rule says as long as you haven't accessed VA services in the past 3 months, you will not be considered to have disqualifying coverage by virtue of the fact that you are eligible for VA services. So what does that mean? It means if you're covered by a high-deductible health plan, you have no other disqualifying coverage, and you haven't gone to the VA for any services in the past 3 months, you're eligible, you're HSA eligible, you can make or receive HSA contributions. What's new is that the legislation from mid-last year said that if you're a vet with a service-connected disability, we'll make that rule even more generous for obvious reasons. And what we'll say is that you don't have to worry about that 3-month rule if the VA services are provided for a service-connected disability. Meaning if you go into the VA and you receive services related to your service-connected disability, we won't even apply the 3-month rule. We'll just say that the blanket matter does not constitute disqualifying coverage. The new ACA Potluck guidance said that they don't really want you to have to keep track of whether you're going to the VA for something related to your service-connected disability or something not related. You know, if your disability is related to your arm and you have some issue with your foot, you have to try and determine whether the foot issue is related to your service-connected disability. They're saying no, as long as you're a vet with a service-connected disability, anytime you go to the VA, you'll be fine. That will not be disqualifying coverage, which means that as long as you're covered by a high-deductible health plan and have no other disqualifying coverage, your VA services will not block you from HSA eligibility. Okay, and then the last topic that we're going to go over here is COBRA and the Health FSA $500 carryover. We've had this $500 carryover for, I think, about 3 years now, and we're finally getting some good guidance on it. But before we get into that, let's talk about what the basic Health FSA COBRA rules are. The first is that if the account is underspent at the time of the COBRA qualifying event, which means you have not submitted for reimbursement as much as you've already contributed into the Health FSA, you've contributed more than you've taken out, let's put it that way, then you are eligible for COBRA for the health FSA, and the caveat being that you're only eligible for the remainder of the plan year. So how it works would be if I terminate from employment today, and my account was underspent, meaning I'd contributed more than I'd reimbursed as of today. The general rule, if I didn't elect COBRA, is that I would only be able to reimburse expenses incurred up to the day of termination today, and I have to elect COBRA, which I can because my account is underspent, to be able to incur expenses from March 24th on through the rest of the plan year that can be reimbursed through the FSA. So COBRA would allow me to do that. After I get to the end of the plan year, my COBRA rights terminate. There's no right to continue on into subsequent plan years of coverage through the health FSA. Now, if the account's overspent, there's no COBRA rights, and basically what that means is that in that example, if I turned March 24th, I'd have to submit claims only incurred on or before March 24th, and I usually have a run-out period of typically 90 days to get those claims in. New in the Potluck guidance is that we now know for sure that carryover amounts are subject to COBRA. And the IRS had sort of informally provided some opinions or guidance on this before, but now we know an official guidance. So that means that anyone who elects COBRA for the health FSA will be able to incur claims for reimbursement from both the remaining balance that they have in the current year, plus any carryover balance that they still had on the books from any prior year. So let's do a quick example that I think will help explain that better. Let's say that in 2016, you're in the health FSA, you got $2,500 elected, and you're also carrying over $500 from the prior plan year, from 2015. And then I terminate at the end of May after I've received $1,100 in reimbursement. So $2,500 minus $1,100, that's $1,400. So for my 2016 health FSA balance, it's going to be $1,400 as of the date of the qualifying event. However, I also have that $500 from 2015. So what does that mean? It means when I elect COBRA for the health FSA, I get the $1,400 from 2016 and the $500 from 2015 that carried over for a total COBRA balance of COBRA health FSA balance of $1,900 available through COBRA. They also said that you cannot be charged for the carryover amount. And, there's this little debate about whether or not we should call this free COBRA coverage or not, because you really have paid for those contributions in the prior year, right? The reason you're carrying it over is because you paid for it and didn't use it. But the kicker really is that you don't have to pay any COBRA premium to maintain that carryover balance. So every other scenario on COBRA, you have to pay this monthly premium every month with a 30-day grace period, otherwise your COBRA will terminate. And that's not the case with the COBRA health FSA carryover amount. There's zero premium associated with the ability to access that amount through COBRA. So in the example that we talked about in the prior slide where the employee termed in the end of May of 2016 with a balance of $1,900, $1,400 of that from 2016 unreimbursed and $500 from the carryover from 2015. The actual COBRA premium amount will be set based on the monthly charge of $1,400, not of $1,900. So what do we mean there? We mean you don't factor in the $500 carryover amount when you're determining the COBRA cost of coverage. You'll only be looking at the amount that's available in that plan year. Okay. So think of that as free of charge, or there's just no cost because you already paid for it, whatever makes more sense in your mind. The other big news here is that, as I mentioned before, there's a very hard and fast health FSA rule with COBRA that said you only get it through the end of the plan year if you're eligible at all in the first place because your account was underspent, which is the first condition. And then if it was underspent, you do elect, it's only through the end of that plan year. There's no right to continue into the subsequent plan year. We now have a big exception to that, which is carryover amounts. Carryover amounts can be available into subsequent plan years for the maximum COBRA period duration, which is 18 months for termination, employment, or reduction of hours. So going back to the same example from the prior slide, the employee terms in the end of May of 2016 after with the balance of $1,900, $500 of that being carryover. And then in that example, let's say the employee through the remainder of 2016 through COBRA reimburses $1,400. So they still have that $500 amount remaining at the end of 2016. Under this new guidance from the Potluck guidance, you can carry over that $500 into 2017 through COBRA. So under the prior rules, that $500 would have been forfeited 12/31/17 at the end of 2016, because there's no ability to continue into subsequent plan year. The new twist here is that if it's carryover, if you have the carryover, that can carry over until the end of the COBRA maximum coverage period. So in this example, when the employee terminated May 31st, 2016, 18 months from that date would be November 2017. So that $500 will continue to be available to the employee for reimbursement through COBRA all the way until November of 2017. A couple of bits of, well, not bits, they're important, of non-COBRA related Health FSA carryover guidance that came out of the potluck as well. The first is that you can limit access to the carryover amount up to $500 to only those employees who are electing the minimum amount in the plan for the subsequent year. So if in 2016, the end of 2016, I still have $500 left in my Health FSA, and I don't elect to participate in the Health FSA in 2017, the plan can say that I will forfeit the $500 from 2016 because I didn't elect a $50 or $100, whatever the minimum is in the plan for 2017. It's not required, it's optional. The IRS is just saying you could put a provision in your plan that says this. To add that, I think you better be very clear in your communications to employees that you've added that, because I think that will catch some employees by surprise. The other one is that you can limit carryovers to a maximum period. So if I carried that $500 into 2017, so I have $500 available that went unreimbursed at the end of 2016, it carries over into 2017. The plan could say that I have to use it by the end of 2017 or any other period. It could say 2 years or 3 years, but let's just say, for example, the plan says you have to use it within 1 year. So the plan could say that if I don't use the carryover by the end of 2017, it's forfeited. So sort of the default rule would be I continue to roll it on and on, 2018, 19, 20, 21, until I'm reimbursed for it or I terminate from employment. In that case, I'd have to go through COBRA to access it. But if you want, you can have your plan terminate after the end of 1 year or some other fixed duration, and therefore forfeit it and not carry over after that fixed duration. Now, if you're going to do that, again, you're going to want to be clear in your employee communications that you've done it, because that, again, would probably catch employees off guard. Okay, in the last 2 minutes I have here at the 45-minute mark, just a few bullets that I think will help streamline what we've just talked about and give you some thinking points. Because again, this is really too much information to memorize, and that's not the point. It's just to come up with some quick issue spotting ability. The first is that HRA integration now just became more complicated for family HRAs, which means an HRA that makes reimbursement available to spouses and dependents. So if you have a situation where an employee can enroll in employee-only coverage and have HRA coverage available for not just that employee, but also spouses and dependents, tie that one up by 2017, because that HRA is not integrated and you're subjecting yourself to potential $100 per day penalties under that setup. The second is the affordability safe harbors are much trickier under the opt-out and flex credits than a lot of employers realize. If you have a flex credit, make sure it meets that health flex contribution requirement by 2017 if you want to count that flex credit toward your affordability on the cost of coverage. And if you have an opt-out credit, beware that as soon as we get regs telling us when they'll take effect, you're going to have to add that opt-out credit to the cheapest plan option, meaning if your cheapest plan option costs $200 per month and you have a $100 per month opt-out credit, your cheapest plan option therefore costs $300 a month. All right, and it's not necessarily intuitive, but the IRS thinks of that as you're foregoing $100 per month, so it's really costing you $300 a month. And then there's inflation adjustments up to 9.66% for 2016 on all those affordability safe harbors. Lastly, we now got some guidance on the $500 Health FSA carryover beyond that initial guidance a couple years ago. Good news for employees, they basically got free access or unpaid, no requirement to pay for access, let's put it that way, to carryover amounts that they paid for in prior years. And those amounts can continue into subsequent years. So there's an exception from the general rule that the Health FSA COBRA rights will terminate at the end of the plan year in which you experience the qualifying event. And then on the non-COBRA side, remember that you can limit the carryover access to only those employees who elect to enroll in the plan for the subsequent year. And you can limit the carryover availability to some fixed period, like through the end of 1 year of carryover, or whatever you want in the plan. But make sure that's in the plan and clearly communicated to employees if you want to do that. With that, thank you for sticking with me on that, and I apologize again that the recording didn't go through with Liz. I really appreciate Liz doing the webinar, and it was only because we had such record-breaking attendance that it crashed our recording on it. So apologies to Liz for her session not being recorded, but she did a great job, and we all really appreciate it, and we hope she'll join us again. She's joined us for a number of these webinars, and they've all been great. And thank you for joining. I know this is dense stuff, and I really appreciate you taking the time to go through it. So if you have questions, please feel free to reach out to one of us, and we'll get back to you as soon as we can. And with that, have a great weekend, and thank you again for attending ABD Office Hours. We'll see you at the next session.